Transform your startup journey with the Energy Tech Nexus. Connect with fellow founders, access critical resources, and be part of a community shaping the future of energy and carbon tech. Your path to building a Thunder Lizard starts here. Learn more at energytechnexus.com. Welcome back to the show. I'm here with Don Kendell at New Climate Ventures, NCV. Don, why don't you tell us about what you guys do and what kind of investments you like to make?
Good. No, happy to, and great to be here. Yeah. So thank you. New Climate invests in innovative early stage startups, building the future of how we produce power and consume. We take an active and diversified investment approach that leverages our energy, commodities, climate, technology, finance, regulatory, market analysis, and investing experience. At New Climate, we partner with entrepreneurs to navigate the early stages of company development and growth by applying our operational, investment, team building, and mentoring experience and providing access to our global network of investors, startups, and corporations to help founders achieve success.
Oh, thank you. And if I recall, you guys were on Fund 1 since COVID, I think is around the time that I first met the firm. And you're at the phase now where I assume you're raising Fund 2, or is there a new thesis that's coming along?
Yeah, we're still have money left to invest in Fund 1. We've obviously reserved money for follow-on investments, but clearly we're at the time we're focusing on what's the next step.
Yeah.
And as you're probably aware, the environment, thanks in part to the administration, when we got started, we had tailwinds.
Yes.
We now have headwinds. We still think the opportunities are there. This is a very, very long-term thesis. And the whole energy transition, which will be measured in multi-trillions, is going to take a long, long time. And we've never done things that are, in effect, based on subsidies. Subsidies can help, but we would not invest in a company where the only way they're going to survive is with subsidies. But still, it's a different environment than we had before, which, not that our underwriting wasn't super diligent, super deep previously, but it's in some ways it has to be even more focused, just given that there's certain areas that are very, very problematic.
Yeah, I guess as a portfolio builder, I definitely understand that the business needs to have its own fundamentals and needs to work. But when you have headwinds, you get your capital back faster, right? And does that change the conversation with LPs in terms of like who they want to fund, or are they coming in because they're kind of just committed to the vertical?
No, I think it probably does change the conversation a bit and does sort of change sort of stage of company to a certain extent. But as an example, we've always been, a lot of people are calling it picks and shovels. So we, for example, like picks and shovels business where you're doing things that enhance existing businesses. For example, take solar energy or wind energy. We would probably not finance a developer of solar or wind. There's a lot of people out there, a lot of people doing it, crowded space. Take EVs. We wouldn't finance a startup of EVs. It's just too crowded a space, too much competition. But things that can enhance battery performance, things that, we actually have a company that's working on a new technology to enhance the efficiency of solar panels. So things around the edges that can dramatically help those companies are right in our target space.
Is that because when you say that it's crowded, those markets are sort of mature already and it's harder to make a profit?
And part of it too is just capital intensity. Like a developer in solar or wind, there's a lot of people out there, a lot of people doing it, a lot of infrastructure funds. And we just don't have the capital to make a big difference for those companies. Plus, as you said, they are more mature. So the returns in project financing are attractive, but they're not venture capital returns. And EVs, same thing. The amount of capital to build a company in the EV business is huge. There's been tons of failures, a handful of monstrous successes. But we don't see, we being the ones to finance a new startup in the EV space. But if we can enhance battery performance, do something that impacts the use of carbon fiber, other things around the EV, could well fit.
Yeah. When I was thinking about how a thesis evolves, I think one of the questions entrepreneurs always have is how much should we lean into a trend? How much should we reframe ourselves as like a data center company or service this market? And it's a challenge because as a coach of founders, you want them to be genuine to their business. You want them to actually like understand a customer and service a need, and not just chase a buzzword. But you can't ignore the fact that a lot of capital is going into that space. And so, when you look at companies, how do you figure out who's authentically targeting a problem, and how do you know this? Something's real.
Now, excellent question. Obviously, we don't want to be funding trends, but certain trends are going to be here a long time.
Yeah.
And what we want to be doing is making sure the companies that we're focused on really have long-term viability. I mean, take your data center, huge amount of money going into it. I just listened to a Jefferies, conference call yesterday on how many announced data centers are not going to get built. So it's an area where everybody's trying to do it. A lot of them won't get done. But even there, we've got companies, for example, that are focused on improving heating, air conditioning, ventilation. One of the biggest issues with data centers is how you chill, in effect, the whole process, whether it's air cooled or water cooled. So again, improving technologies that can help the data center is something we take a look at. Would we do a data center development? For our fund, it just, again, doesn't fit too much capital.
Yeah. But I guess I'll pry a little further. We did our pilot-a-thon in September, and it was amazing to me. I want to say like 40 or 50% of the companies that came to present, they're all very early stage technology companies. And it felt like a large portion of them were trying to like rend their product and business model around trying to provide power to data centers. And as a, unsophisticated reviewer, it was hard for me to tell if that was just chasing a problem, so to speak. Do you find that's a challenge when companies approach you, that they're trying to chase something they're not really an expert in, or is there a filter you apply?
Yeah, clearly when we're evaluating companies, management is key. And there are a lot of people chasing trends and they don't necessarily have the expertise. In data centers, what's interesting, probably as recently as 9 months ago, the monster data center users wouldn't really talk to projects that didn't have grid-based power. That's changed. As you've probably seen, a lot of political commentary on our data centers increasing the cost of power for everybody else. So the data centers are being more sensitive, and more are looking at what's called really behind the fence type projects. So in effect, you self-generate, and there's just tons of opportunities there. Yeah. And as you've also probably read, you can't get the big GE turbines timely. Yeah. So you're looking at lots of alternatives to get things started, and then potentially put in combined cycle turbines make the most sense for data centers, in my view, because you also have steam being provided, which you can use for, in effect, powering the chilling. So you've got one use of fuel that produces both electricity and helps, in effect, run the chillers. Whereas just using, either batteries, using fuel cells, using others, you still need to come up with a way to power the chillers.
Yeah, interesting. Yeah, the cooling. And I guess as the systems get denser, the heat problem only gets more intense, right?
What is interesting, though, I'm working with a data center, helping them on the side, and they're working with a customer, can't disclose their name yet, that has much more efficient chips than NVIDIA. And so if that's true, they'll be able to have, in effect, more density, but not use more power and more chilling.
Interesting. I think in a time like today, we're like 3 weeks into the war in Iran. We're a week ahead of Zero Week, and I think the top question that all of us had going into just the beginning of the year was, where are people deploying capital today? We know it's data centers, but what else are people doing for an investment strategy? And here today, I think, not even today, I think I saw oil cross $110 a barrel at the beginning of the week. It changes everything in terms of how people were thinking of deploying capital. As a fund manager who has to think about a portfolio that needs to, last and build value over 10 years, how does that structure your thinking today?
Yeah, no, clearly, I think the whole war was unexpected. I think, obviously what's happened with oil and the whole oil environment was not expected. And like I think Goldman just came out with a report that we're going to be into the $100 barrel of oil through 2027.
Yeah. And everyone was predicting $55 a barrel in January if I had my ear to the ground with the energy companies.
I'd say from a global perspective, the biggest thing that's done is cause countries, Europe in particular, but probably even Asia, that are very, very reliant on fossil fuels to say we really need to be more energy independent. And that could well be a big increase in renewables in countries where renewables make sense. So I do think in some ways the unintended consequences will be a refocusing on alternative sources of electricity, in particular energy in general. So again, we don't think you want to make investments based on $100 oil for the next 10 years.
Yeah.
I mean, I do expect that to go back to a more normal level. But I mean, for our companies, what we're looking at, we have one company that basically is using animal materials to make substitutes for plastics or leather. And obviously plastics generally coming out of the petrochemical process, so that, for them, this is a nice potential tailwind. If in effect alternative, sources of plastics are more expensive, this gives them a pretty interesting opportunity. We're also looking, I'll call it broadly defined, recycling. We have a company that is taking, they call it red mud, but the waste product coming out of making aluminum. And for every ton of aluminum, you have 2 tons of the red mud. And it's just been sitting in holding tanks. Hazardous waste, big issue over time for these companies. It has in it a lot of iron ore, some titanium, some aluminum, and some rare earths. And so this company is processing that to extract, in effect, those materials out of it. And they end up turning the 2 tons into 20% of what I'll call waste that generally is not going to be hazardous. So that, it really is economically attractive because they're taking out valuable materials from the waste, but they're then also effectively disposing of a hazardous, waste pond, in effect. So we like opportunities there, and those are going to, I think, continue to grow. We have another company that recycles carbon fiber, and same thing. Carbon fiber manufacturing is very, very energy intense, and a lot of the underlying customers, want the carbon fiber to be recycled. So we're really looking, I'll call it around the edges for things that get exciting. I'd already mentioned in solar, we have a company that's, working on improving the efficiency of solar panels. And then in the picks and shovels, we have companies that help with measuring carbon or things like that. Another company that's really helping developers decide whether sites are attractive for a power project, a data center, or other opportunities like that.
Yeah, interesting. It makes me think, especially when you talk about downstream processes from oil. It's not just the fuel we put in our car. It's all these chemicals, advanced materials that are that require kind of an upstream fuel source. They're going to get more expensive, and especially with petroleum alternatives, it's challenging to know if customers will actually pay for sustainability. Previously, and I think in the last year or so, a lot of the carbon initiatives we saw really, I don't know if they evaporated from the business plan, but they definitely evaporated from the conversation. And it wasn't enough to say we had an alternative to carbon, because the price premium just wasn't very substantial. And I think a lot of companies were trying to figure out, how do we make stuff at cost parity with the petroleum product? Well, in the short term, that calculus has changed. And I think I was looking at one of your companies. Are you okay with me naming some of the companies? So I was looking at Air Company. Loved what they were doing a few years ago. I think they did a carbon to value program. If I remember correctly, they were originally making like alcohols or perfumes.
Originally, it was actually vodka.
Vodka, okay, that's what I meant. Alcohol. It was alcohol, and
then we switched during COVID to hand sanitizer.
Yes,
and now the focus is much more heavily on fuels.
Yeah, and so was that switch a long time coming, or was what shifted in the ecosystem that said we're going to do? I assume, is it SAF, or is it some sort of, or is it any sort of diesel alternative?
This is more diesel related. Another company of ours, Dimensional Energy, clearly was early on focused with SAF.
Okay.
And what's interesting, though, they've also found out that waxes that can be used in cosmetics and other things, a lot of those are petroleum-based.
Yeah, like paraffin, petroleum jelly,
Yeah.
right?
Yeah, exactly. So that in addition to SAF, they're also focused on, other products that are replacing, petroleum-based products. So I see companies like that, again, it's back to having some tailwinds. We thought they'd get there eventually. And back to your earlier point, all the airlines want to use sustainable aviation fuel. And right now, clearly it's not as economic as jet fuel. But if you blend in a very small amount, it doesn't really impact the overall cost of fuel. And what we think that'll help is we keep increasing the size of our projects at the underlying companies. So what we're trying to do is obviously get production up and getting fuel costs down. And as that gets there, we'll hopefully get to parity with jet fuel. It clearly will take a while as we keep, improving the whole efficiency of the process. But the good news is the airlines will buy, reasonable quantities of it, even when it's more expensive. Long term, we don't think the companies survive without being at parity. But, fortunately, there's really a bridge to get there by all the major companies wanting to see it happen. And they're willing to try at lower quantities, make sure it works, make sure it doesn't do anything to the engine, which won't, et cetera, to really get the companies rolling.
Yeah, I'm very curious, and I know you're very passionate about climate and preservation of kind of our ecosystem. But you have the title venture capitalist, right? And when we think about kind of capitalism, it's always about getting the best price for your dollar at the most economics. And when you come in with a sustainable aviation fuel, you have to kind of say, it's the same product. We have this thing that's less carbon intensive, but I'm going to charge you twice as much for it. And I think it's unfair to say a capitalist would take that deal, right? And when you're coaching these entrepreneurs and kind of selling this higher priced product, how do you help them, sell this thing that just economically has an ephemeral value almost?
No, it's a great question. Again, as I said, if we don't think they can get to parity, we won't make the investment. So that we really are looking for technologies where, as you scale it up, because obviously the bigger the size of your project that's processing it, generally the unit cost of your ultimate product is going down. So, and same thing, your inputs. If you're buying lab scale inputs, you tend to pay a lot more. If you're buying commercial quantity inputs, you can negotiate better pricing. So it's really a function of getting your input costs down, getting your efficiency of the plant up, and then obviously, getting the overall cost of materials down. So that we really won't do a company where they need a premium to be successful. Now, it may well be the market will pay them a premium, and as capitalists, we're happy to have them, take advantage of that. But over time, if we don't believe they can get to cost parity, it just to us won't be a viable business.
Do you think customers have that same lens, like when they're doing diligence on this very small vendor?
As I said, we've seen it with the major airlines. They are willing to pay a higher price than jet fuel to get the product in, be able to tell customers they're using sustainable aviation fuel. But it's clear, I don't think they'll do that forever. They have the same goal, is by helping these companies grow and get started, they'll be able to get the efficiency to get the costs down.
Do you feel like they're doing the same level of diligence as you are, or more or less? Or are you a signal for them?
Yeah, I probably almost view it both ways. In some of these projects, we have major airlines as investors. And some of them would like to buy all the fuel our companies can produce forever. And obviously, we'll work on what will help us make that mutually beneficial. So, for example, them helping us project finance the next bigger project. So there are ways to keep them involved. But I do think the airlines do a lot of due diligence. They're looking at a lot of sources. They aren't going to just invest in one SAF company or one particular type of technology. They're going to spread their bets till they know they work. And obviously, there may be some they believe in more as they learn more about the process. And they may increase their bets on the ones they really like and cut back or eliminate the investments on the ones they don't think are going to be able to get there.
Interesting. We don't have to spend too much more time on airlines, but I know they usually buy jet fuel on a spot market, so they're really exposed to the swings on oil. Does finding alternative sources help them reduce volatility, or is that still kind of marked to?
I mean, as the price of SAF comes down, I think it will help with volatility. And some of the airlines do hedge, and you've seen over time some of them make huge profits hedging and huge losses hedging, and so it's a tough process for them. And but you're right. Historically, they pretty much bought spot, and that creates a lot of swings in their own, in effect, revenue.
Yeah, I got to buy flights for our spring travel, and I'm kicking myself for not buying them 3 weeks ago. Because I'm sure I'm going to pay for it now.
They definitely will pass through the increases in fuel costs quickly.
Yeah. So I'm curious, what really, I alluded to earlier, what's really drawn you to have a career in kind of climate investing generally? Because I know you've done more before even New Climate Ventures.
Yeah, just going backwards. I mean, I started out in investment banking and relatively early on was asked to specialize in project financing, leasing, structured finance. And where I was fortunate, a lot of that was at the time the whole U.S. power industry was deregulating. So an awful lot of the work I did, again, focused heavy capital assets, every industry. So autos, airlines, shipping, railroads, steel. So everything heavy capital intense, but really the biggest sector ended up being the electrical power industry. So got involved early in coal-fired plants, nuclear plants, natural gas, and then into the newer technologies. So I actually financed the first geothermal project that didn't have an oil company guaranteeing that the reserve was there. And interesting enough, that was the predecessor company to what is now Berkshire Hathaway Energy. So it's inside of Berkshire Hathaway today. And financed early wind projects, early solar projects. One of the earlier types of energy storage called pump storage. So basically a big reservoir, ideally a big reservoir here and another one down here. And when you need the power, open the floodgates and you produce power. At night when power is cheap, you pump the power back up to the reservoir. So really got access to all the different types. Using wind as an example, a lot of the early wind projects, and you could go 20 years ago along some of the areas in California, you'd see 80% of them weren't moving. And so they were trying new technologies. A number of them just didn't work. But I got really intrigued by the opportunity with free fuel, whether it's wind or solar or relatively cheap fuel with geothermal, and I do call nuclear renewable. I mean, obviously the issues are more waste disposal than anything else. And in effect, having environmentally friendly type of fuels that are very, very economic. So I really got intrigued with that. Plus I have kids and I have a granddaughter. So, I mean, being sustainable and making sure the world is here for them 30, 40, 50, 100 years from now was important to me. So really got excited about what was going on in the whole space. I also was fortunate. I was asked early on to be a board member at Solar City. And that's one of the early residential solar companies where we added unique value. One was trying to change processes. For example, initially we would put every, in effect, small solar power plant on somebody's roof piece by piece. We then saw a company that was doing it on a modular basis. Everything was assembled on the ground, and then you put the modular up on the roof. So we could go, with that technology, we could go from doing, in effect, 4 days for one project to 2 projects a day. So dramatic increase in efficiency and decrease in labor cost. And another thing we did was financial engineering. If you went and tried to sell somebody solar for their house and say the payback was 10 years and you've got a pretty hefty capital investment, even though they may want to do it, the 10-year return of your capital just wasn't exciting for a lot of people to do it. If we went to you and said, okay, you're paying Y for power now, it's going to inflate it, whatever you think natural gas or coal or whatever is inflating at, Or we'll put a solar unit on your house. We'll give you a 15% discount off what you're currently paying, and we'll just inflate with inflation. And so when you looked at that, no money down,
I'd take that deal.
Immediate savings. And what we ended up doing is obviously that required us to have tons of capital because we were financing our customers. And what we decided to do is go to the securitization market. It took a while to get the rating agencies comfortable with it. But when you think of it, what are you going to pay first? Your home mortgage, your car loan, your electric bill.
Yep.
And if we cut you off, you're going to pay more for your electricity.
Yep.
So you could really make strong arguments that your electric bill is at least tied with your car payment and your home payment. And so we're able to get securitization done, which dramatically impacted our capital raising.
Interesting.
Just using that as an example.
Yeah.
Are you ready to lead the decarbonization charge? Energy Tech Nexus is your platform for growth, offering unique resources and expertise for energy and carbon tech founders. Join us at energytechnexus.com and start building your Thunder Lizard.
I think going back, just to bring my own experience into this, I had the opportunity to start my career in the early 2010s. And the kind of recommendation that was told to me was, don't say you're building a clean tech company, because this had come off the, I think, failures of a bunch of big climate companies and a lot of challenges before the exits of Tesla and SolarCity and others. And, as someone who's heard kind of the legends of all these technologies that were tried and failed, I'm very curious if the risk appetite was better or worse than it is today in terms of like getting these big projects off the ground, or if there's just something different in the way projects get funded. Because it feels like, just someone growing up in the space, there were a lot of these like high stakes companies that with very risky technology that got a lot of capital. And it is a very common question from founders today of like, how did that one get funded and I can't? Mine's better. Right. And I don't know how we square that, because we honestly don't have the lens of history and being there. And so I'm just curious, like what your sense is.
No, it's a great example, but every first of a kind project is more difficult to get financing. I'd mentioned the geothermal project as an example. Historically, the banks, the insurance companies, all the lenders would not take the risks that the geothermal would keep producing. And we were able to show lots of studies. I mean, there's a project that's probably at least 125 years old in Iceland that's been producing geothermal continuously. So the more data we had, we could show the banks that, basically if you poke a hole in the ground in the right place, it will produce steam. If it gets gunked up, you can poke a hole similar without a ton of extra capital costs, so that we got people comfortable that, one, the resource was there, and number two, that you could actually keep using that resource over extended periods of time. And then once that first project gets financed and works, obviously all the follow-on projects are much easier. But clearly the most difficult thing is getting people comfortable. And then what you want to be able to do, I mean, example is, the geothermal company, here in town. They're using basically oil and gas techniques. So going very, very deep. They just announced they got project finance debt on their first project.
I saw that this week. Yep.
And so to me, I think what happens there is the banks that are involved in it have had experience with oil and gas financing, probably have experience with other geothermal financing, and they look at where are the similarities on what's worked, and then what could cause this not to work. The difference here versus typical geothermal, obviously the holes are a lot deeper. So I think your capital cost is going to be higher if you have to do replacement wells, but still it shouldn't be a big technology risk. So it's just basically, once you're comfortable that the technology risk has been, basically I'll call it ring fenced. So it's not a big problem for you. You can get comfortable with the project financing. But you're right, it's really tough to sort of figure out, why company A that's interesting gets financed and company B that may seem equally interested doesn't. Part of it, I think, is management teams. And I hate saying that to criticize people that don't get financed. But, for a while, almost everything in the space, if it wasn't something that Elon Musk started, it didn't succeed.
Mm-hmm.
So you had a lot of venture capital firms 20 years ago that got in early, thought there'd be great tailwinds in terms of being successful with the sector, and it was too early.
Mm-hmm.
And I do think now, even though we have governmental headwinds, I do think the opportunities are there and people see the long-term vision of what they can do. You've had enough successes that help. But still, every new EV company thinks they're different and better, but you're still going to have, I think, a lot of failures in that space.
Yeah. No, so in some ways, it is easier because people have history now to look at. And we also have more competition because there's a lot more companies wanting to go out and build something. And it's, I think we are living in a good time, honestly, because it feels like it was much more challenging because you really were doing a first of everything before.
No, and project financing, to me, I always boiled it down to three simple things. What are your inputs? What are your outputs? And you need to make sure, obviously, that your cost of processing means you can make a decent margin. But then the bigger thing is whatever you're using, does it work? So that technology risk, and that's where the first in kind is problematic. So, and it's also why a lot of people start with a smaller scale. So we can show you that the technology works. What we can't necessarily show you, can we up it by 5,000 times and it still works at scale, and we can drive the cost down as much as we need to make it work. So if you look at a lot of the companies we'll invest in like that, we won't do just a science project. We want to make sure it actually does work, even though it's not commercial scale. But then we're making the bet that it can be commercialized, which means scale up to commercial scale, scale down cost to make it economic.
And I guess let's delve into that. Like, what are you looking at to get confidence? Is it the management team? How deep are you getting on the technology? And I don't know how to say this politely. How much do you trust the entrepreneur?
Great question. It's really all the above. I've found from my experience in really everything, the most important thing ends up being the team. Because you can have many companies, you hit a roadblock. And if you don't have the right team, they just give up. If you have the right team, they'll find a way to work around the roadblock. I mean, good example for me was just, I moved to Houston to work with Bob McNair as president of his power company. And Bob was just phenomenally persistent in terms of getting things done. And we had a monster contract working on with Con Ed. And, they had a 5-year contract that was a standard contract and a 25-year. You really can't finance a power plant with a 5-year contract. The 5-year contract was great. The 25-year contract, the economics weren't very attractive. So we signed a ton of 5-year contracts with the hope that Con Ed would come back and say, what are you doing with 5-year contracts? And Con Ed came back and saying, we want your project, but we really have a problem with the 5-year contract. And I said, well, we think power prices are going up significantly. So we love the 5-year contract. And kind of, so what can we do to get you a long-term contract? We said, standard offer for 25 doesn't work, but you're the customer. Let's see if we can work something out. So we worked out a transaction lower than the 5-year, but way higher than the standard offer at 25 that was phenomenally economic. And we actually were able to get it financed at 150% of the capital cost.
What does that mean?
So basically, the power plant cost around $500 million. We financed it for $750 million.
Okay.
So the day we started production, we pulled out a $250 million development fees. A simple way to look at it.
Interesting.
And it still had nice margins, after serving the 750. So again, there, to me, we were using standard technologies. We clearly had a great team in terms of doing all the development work, the permitting, the things you need to do to make it work. We made sure the inputs, natural gas primarily at this point, and the outputs, electricity, matched, so we had a nice margin. But a lot of that happened because we had a unique management team that was very persistent, very effective in basically developing the project.
I'm still stuck on 150% of value against the project. I guess.
Well, think of it.
Because everyone has to get paid, including the development team.
Yeah.
And that's a mechanism to pay for your FEL 1 through 3, right? Is that the way to think about it?
Yeah. But it's unusual. I mean, I've seen very few projects that you can pull out 50% of the capital cost as a profit before you've really started making revenue.
Yeah, or running. Yeah.
Yeah, they wouldn't pay it to us until the project was up and running.
That's understandable.
We didn't do it the day we started construction.
Yeah, but I guess it speaks
But then back to your other questions. I mean, so we'll do a lot of deep digging on the experience of the management team. What have they done before? You know, what is their expertise? What does the company need to grow and be successful? And then on technology, you know, we'll, if need be, we'll hire outsiders or we'll partner. Like what we love going in with strategists because they tend to often have the technological skills that we need to outsource. So, I mean, but we do want to dig deep into, does the technology work? And as I said, what we're trying to do is we don't want to take the risk the technology isn't going to work. What we're taking the risk of is, can you scale it and commercialize it?
Yeah.
So we need the plan and the vision to scale and commercialize. Because generally, if you're at that stage where they're going to scale and commercialize, it's probably not venture capital anymore.
Yeah. Do you find a team, and I know every team's different, do you find the team needs to have been together a long time, or are you really looking for, well, tell me what an ideal team looks like.
It is clearly helpful if the team has had some experience together. Because as you know from your own businesses, interpersonal interactions are very critical. And you want to make sure they're not all clones, i.e. you want to make sure there's diversity of skill set, diversity of way of looking at things. And then also, so they'll listen to each other. So if you know, I do tend to think the community as a group is smarter than the individual. And so I think it's very, very critical to have, people that can work together, listen, learn from each other, fix others' mistakes. But so clearly having had a team that worked together is helpful, and at least knowing each other for a while is helpful. But, it's not necessarily definitive. We can come up with a team that hasn't worked that long together, but they put the right people together and they can still make it work.
Especially if you have a gap that you need to fill, you got to bring in some new blood sometimes. Yeah. Let's see. Oh, okay. Here we go. Sorry. I'm trying to remember what we usually ask. I think one of the challenges we've been seeing in the market from like an investor perspective is a lot of funds got started right after COVID. I think there was a lot of capital, honestly, that came into the system, and just as an observer, it feels like a lot of early stage venture funds are not able to raise fund 2 or fund 3, and even those who have prior vintages are raising smaller amounts of capital. And I think as a founder, it's hard to understand what's going on or why. And on the one hand, I'm hoping you can give us some insight to why there's just this long cycle where maybe there's less capital coming into venture, but also how we should view that as like we plan our own financing. Yeah.
No, it's another very, very good question. And you've probably seen there's been lots of articles recently on the whole alternative investing sector underperforming what people's goals were.
Okay.
So there's been multiple articles on university endowments. There's just one I saw this week on 3 or 4 of the monster Canadian pension plans, basically having negative returns in their private equity portfolios.
Okay.
So that obviously impacts capital allocation to the sectors. I tend to be a believer when things are crummy, it's often a good time to get in because you'll hopefully be on the up cycle. But in the venture side, clearly, and again, from my analysis of venture from when I ran a family office, historically, the top venture firms tend to keep doing pretty good.
Yeah.
And there hasn't been as much correlation of, mediocre venture funds improving. And so that it did really say that in venture, if you were an index fund, you wouldn't do very well. You really need to be in the top funds. I think that will probably continue persisting. there for a while was a lot of capital helping new funds start because there was good data historically, both on private equity and in venture, that the earlier funds often do better. I.e. the founders need to make it work well to be able to do fund 2, 3, et cetera. And I just think it's gotten more difficult, in part differentiating, but then in part the types of capital. There's still high net worth investors that are doing venture. There's still pension plans. There's still others. But what's happened because of the overall returns, a lot of them are focusing on fewer relationships and bigger relationships. So getting into the institutional capital, I think, has become, somewhat more difficult.
So they themselves are concentrating where they put capital on it. I don't think they're related, but it seems like a lot of the venture investments also went into bigger deals and less companies in the last year. I suspect that's more to do with geopolitics of just making sure your good companies are well funded.
Yeah, but part of it to me, though, is with the AI cycle, you're seeing, I think, a lot more focus and excitement on AI and robotics. So that those areas, I think, are still able to raise capital, and everybody's sort of changing. I mean, most of our companies use AI, but we're not an AI fund.
Yeah.
And so, but you are seeing people sort of shift to say, yeah, we really are AI focused. and you might have seen, I think it's just in the paper today, but Jeff Bezos is out trying to raise a $100 billion fund to basically acquire manufacturing companies to improve their operations by using AI.
I did not see that. I'm not surprised because I saw he's been working on this 6 months ago. So I guess the question I want to ask is if people are kind of going over here to AI, why is now the time to continue to invest in climate? And you mentioned maybe because we're in a down cycle, but I guess what's the I don't know if this is the sales pitch to the LPs. Why should they pick to put the capital generally in our sector?
Yeah, no, I think part of it, as I said, the energy transition is still at early stages. And I think it is going to continue being multi-trillion-dollar opportunity as we keep moving in that direction. And so I think that we're still at the early stages. And there's going to be many, many companies that can break out and do phenomenally well, whether it's sustainable aviation fuel, it's things like, finding ways to, in effect, do rare minerals, for example. And, we also have companies that are using CO2 or others to process other materials than sustainable aviation fuel. So there's a lot of ways to, in effect, create new products, new efficient products at lower costs. And that's the key. Again, I don't think we can assume people will pay a premium just because it's a product that's helping the client. So it's got to be competitive as is. But I think there's so many opportunities in the space in general that I'm still very excited about.
Yeah. I think when New Climate Ventures started a few years back, Houston was still developing as a hub for climate and energy. And since that time, I think a lot of things have been put on the map. The ION got started, Greentown Labs this year. We even have a Climate Week now. What role do you think Houston plays in terms of that deployment of capital for venture capital and the energy transition?
No, I mean, clearly where Houston should be able to differentiate itself. And I've worked with both Greater Houston's partnership and committees for probably a few decades now on how do we get Houston to where it should be. As the energy capital of the world, how do we transition to continue to be the energy capital of the world? And I do think we're doing a lot of things right. I mean, the good news is we do have a lot of the major energy companies here already. That also brings tons of skill sets here. So, for example, you mentioned, do we move companies here? One of our companies was New York based. They were looking at San Diego and Houston is where to move the company. They needed technical people with chemistry and other technical backgrounds. The founder's a surfer, so I was amazed he picked Houston over San Diego, although he does still surf in Galveston Bay. And basically the reason he picked Houston was very much the fact that he could get more technical people that he needed to hire here than he could in San Diego. And so I do think when companies are looking at starting here or staying here, just the quality of the educational institutions we have, the people that are here already, that have technical backgrounds that can help. And Houston's always been a city that makes things as opposed to, other cities that are a financial center or, services focused. So that the fact that we make things really, I think, does make it easier for companies to be here. And I do think we're getting more and better support too from what I'll call, the government, both at the state level and at the city, county level, to really focus on the opportunities that are here. And I think a lot of it is a messaging issue. Like Pattern Energy, may not have heard of it, one of the big renewable companies. It's been San Francisco headquartered for a long time, but it was sort of co-founded by people in Houston. It's had more employees in Houston, or I shouldn't say Houston and Texas, than it has in California. So a lot of just messaging. We're viewed as old fossil fuel, but the transition into the newer technologies has been pretty dramatic.
Yeah. Do you find companies here in Houston that fit the portfolio?
Yeah, we do look globally, but we do find companies here as well. I mean, we've been very excited. I've been involved in the Rice Business Plan competition since it started. I've been a judge forever. Yeah. And it does, that I think has really helped the ecosystem here. And I think it's probably 42 different universities are participating. And a lot of those founders are seeing that there is a real community here. I do think a lot of the other aspects, Han, I think, has continued to improve, got better. Your firm, there's a lot of groups focusing on energy and energy transition here now. And so are we where we need to be? Not yet. A lot of it's continuing to get more service providers in terms of venture firms, the law firms, et cetera. But we really have improved dramatically, probably since New Climate Ventures has been founded, but clearly since I came here 30 plus years ago.
I think one of the struggles we have is we do have a good cohort of startups that are here that are coming out of programs like Rice. And obviously there's the Houston Angel Network that's supporting. We have Swan now in town, but it's unclear that the crop of climate startups can raise the rounds they need to get to that next stage. I think typically a seed round for a climate startup needs to sit between $1 million and $2 million, especially if you're building hard tech. And my unfortunate advice sometimes is you have to go to California, you have to go to New York. And the question is, why aren't there more investors here? And I think that's not a supply problem. I think there's plenty of capital in Houston. My concern is maybe the startups still need to have, I guess, more maturity or more support to get to the stage where the local capital will invest in them. Yeah. And that might be a controversial opinion, but I think that's a realistic assessment of kind of the quality of companies we have here. If I had to put a guess on it, I think there's like 2 to 4 startups in climate energy that come from Houston and the greater area who will probably raise a meaningful seed round. And I think you guys did one of the investments last year in Solidec. That was one of the 2 I would have picked. Yep. I guess do you agree or disagree with my assessment that that's kind of the limitation or the restraint on why there are not more companies getting funded locally?
It's still an issue, but I do think that issue, unfortunately, now with this environment is almost everywhere. Yeah. Okay. So it's not just a Houston problem. Everyone always wants capital, and they always want to blame the local investor community. Is what I'm hearing. Okay. Well, I appreciate that going deep on it. I think you're not supposed to ask investors who their favorite company is, but I want to know, what do you think is the most promising technology or technology trend you've seen in the last 6 months that you're just excited about? Yeah. Now, it's interesting. I mean, some of our earlier investments in the whole CO2 to SAF or things that are substitute to oil projects, those I think are getting traction, and I continue to be excited about it. I'd say in terms of the newer things, it really is looking at how can we, in effect, either recycle to create rare earths, or use interesting processes to create other materials. Like we have a company that's focused, as you mentioned, on peroxide. And we like platforms. They're looking at other potential, products as well. So those to me are very exciting.
Good. Is there like a book or a resource you recommend every founder reads or listens to?
Probably should be. I do a lot of reading, and but I can't think of one offhand that I would say is the best one I'd recommend.
Yeah. And then go ahead.
I was going to say one, though, that I do think is worth reading just because of the lessons is it's probably one of the original biographies of Elon Musk. Yeah, the chapters on SpaceX to me were most compelling because he almost failed multiple times.
Yeah.
And it's just intriguing, how much he did to learn about it, to get things rolling, and just, again, the persistence to stick with it and make it happen.
Yeah, I was hearing you say, the leadership teams that are resilient are a really big driver for you. And I think the thing people forget about with Elon Musk is how much he doubles down on himself and how much he's willing to put that bet, and that makes him really need to succeed. And it's a lesson in resilience for sure. So I would definitely concur with that. If you were not doing investing, what else would you be doing today?
Yeah, it's a good question. I mean, the things that I'm also passionate about are really wildlife conservation. So I've been involved very fortunate, involved in a number of different organizations, including like the Jane Goodall Institute, who just was a real hero of mine, and got to know her quite well, which was great. I've been fortunate. I get to go on many, many different trips researching wildlife. So my daughter's a conservation biologist, so I went with her on some of her research in Kenya and Tanzania while she was getting her PhD. And so those things, I still make time for them. But if I wasn't doing this, I'd probably even expand the time there.
Where is the last place you went for conservation travel?
I was in Botswana last October, November, I think it was. But for example, for a while was on the board of Bat Conservation International. And here in Texas, they have a cave called Bracken Cave, which has over 15 million Mexican free-tailed bats that raise their young. And it should be one of the wonders of the world to go in the evening in the summer to watch the bats come out of the cave. So there's just so many different things that I continue doing in that sector that it's tough to sort of just pick one or two.
Yeah, no, I understand. No, well, thanks for coming on the show and sharing your passion with us. And we look forward to what you guys accomplish in the next few years.
Great. Thanks for having me.